Hi, everybody. Welcome to the live stream today. We're looking forward to getting into the discussion today. Hopefully, get a few more people in as we get things rolling. We'll be making this available as well after the fact. So you have an opportunity to come in and excuse me, uh, and view this after the fact as well. But we will let's go ahead and dive right in. One of the things that is interesting about the market right now is the way that it has been going up for really all of the past really almost year and a half. From actually more than that, excuse me, for going on almost about 21 months, so nearly 2 years after watching the market. Uh, Drop into bear market territory in 2022 as the Fed was raising interest rates. And there were a lot of indications that the economy was struggling in a post-pandemic world. Um, that set the stage from late 2022 all the way through 2023 for the market to begin rallying. Why is that? Well, there's a couple of different ideas around the way that the market ebbs and flows, and they're primarily related around technical concepts called trends. And one of the first of these concepts, let me just share my screen really quickly so you don't just have to stare at me, but you can see something else to look at here. There we go. One of those principles is that all trends are finite. What does that mean? It really means that at some point, every single upward moving market is going to begin to go down. It also means that there will be a stage. Just a moment. Welcome, FV. Glad to have you here. Okay. What does it mean that all trends are finite? It means that no matter whether the stock market is moving up or down, at some point that trend ends, and when it does, that means that there's going to be a new trend developing in the opposite direction. So it's easy to believe that when the market is going up and up and up and up, that it's never going to end. And for growth investors, seeing something like like the trend that we have right now since 2022, late 2022, having just a constant surge upward. I mean, just a minute, sorry. Can everybody see that green arrow? You may or may not be able to, but I want to find out. Go ahead and put a comment in the chat if you can. Okay. The simple fact is that no matter how long these trends last, at some point, they're always going to end. It's easy to believe that when we see something like this, where this trend line is going up, that it's never going to end. But the simple and plain fact is that that's not going to happen. At some point, every single trend reverses, and this will inevitably begin to bend back down and 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 reverse direction and begin to establish a new downward trend. That's just the plain and simple fact of how every market goes. Thank you, Effie. I didn't think that you did. So got a lot to remove here. Just a minute. Okay. There. Okay. Sorry, everybody. All right. So at some point, we know that every one of these trends are going to end. That's just an inevitability that we all have to deal with. That means that uh, we want to be able to pay attention not only to when those trend reversals happen, but also specifically to the different areas of the market that they're going to impact the most. The stock market is made up a lot of industries and sectors. Sectors are different pockets of the economy that represent different types of activity: real estate, industrial activity, financials, where we see a lot of banks and mutual funds, institutions, those kinds of things. Consumer discretionary, which are usually things like retail stores, consumer staples, grocery stores, those kinds of things. These are all just examples. We can track we can track the activity in these sectors and contrast them against the broad market to try to evaluate what the current not just what the current direction of the broad market is, but also to try to identify the pockets of the market that are seeing the most activity. And this is activity that's represented by institutional investors. As no matter how much I might think of myself as an individual investor, the simple fact is that I don't have the resources to move the market by myself. Very few individuals do, unless you're Warren Buffett or a handful of others. Um, that means that the institutions, mutual funds, insurance companies, investment banks, these kinds of organizations are really the ones that are the most responsible for determining the direction of the market at any given time. Now, that also means that the different industries that they're going to invest in are going to be, as they move money to and from some of these different sectors of the economy, we're going to see stocks in those sectors and the various industries that are tied to them also ebb and flow. So the question is, how do we try to evaluate that and measure that? Measure that. There's a simple term that I like to call sector rotation. That a lot of people will try to use. There's a couple of different methods to sector rotation that you can apply. I'm going to show you a couple of different really simple ones that I like to use and that I try to revisit every so often. So let me really quickly compress my view here. I want to try to shorten this to about a 1 year view of the market. So there we go. We can see that the market over the last year has risen from a low point at around 4,100. This is the S&P 500 index. It's risen from about 4,100 to its current value at just a little below 5,500. That's an increase of sorry, I'm trying to do math in my head, of about 1,500 points relative to where it started. That means, I'm just doing very round numbers, that means that the market has increased in value by about 36.5% over the last year. This is a good reason that I want to go and take a look at what some of the different sectors are doing, because that kind of move in 1 year, it's easy to think that the market is just going to keep going up. A rising tide lifts all boats, for example. But the truth is that the longer this goes on, the harder it is to maintain. And you can try to gather some clues, not about necessarily about when the reversal is coming, but where are some of the sectors in the market that you can pay attention to that might give you a way to benefit if and when the market begins to decline. I like to use I like to use this sector rotation idea to try to find industries and sectors that are underperforming the rest of the market right now. As they diverge from the market, then what we usually see is that when they kind of come back into favor, then they'll start to go back up. So here's a simple way that you can do this. I'm using my trading view is my charting tool here, and I've got a watch list here that I've put together of all of the of several different ETFs that are tied to specific sectors. These are spider ETFs, which are also set up by the Standard & Poor's, the same company that manages the S&P 500 index. So all I'm going to do here is I already have the S&P 500 on my chart, and I'm just going to add the symbols for each one of these ETFs to my chart. And it's going to plot a line for every single one of them as I add them. So I'm literally just following the list of symbols in my watch list and plugging them in to the chart as I go. Don't worry too much about which sectors these are, because I'm going to show you in just a minute how to kind of drill down to see exactly which ones are the ones that are worth paying the most attention to. So now we see a whole bunch of different colored lines. Each one of these lines represents one of these different ETFs. And this gives you a really nice way to contrast the way that the market is moving against the different sectors that make up the economy. This top line, this blue line that we see, this is the technology sector or ETF. So it's tied to the technology sector. And it has clearly been the top performer for most of the past year. Just like with the S&P 500, that's been going up to such an extent that it's hard to really try to take that too seriously in terms of thinking about it as a potential bargain or a place to find a lot of really useful values. A lot of these tech stocks if you followed Nvidia, Microsoft, Apple, etc., they've been following the direction of the sector in general, and are also at very elevated prices. That's not really very interesting to me as a kind of a contrarian investor and somebody who's trying to find value. So that's going to be one that I'm really not going to pay a whole lot of attention to. On the other hand, the lines that I can see that are not necessarily going down, but are in the lower range of the chart that I'm seeing. And on the right hand side, what you have is a list of the performance numbers of each of the ETFs and the index that are on the chart. This 35.28 is the S&P 500. So this is the one that we're measuring everything against. The technology sector, as I mentioned, has clearly outperformed even the index with a rise of more than 56%. I think it's about 58% for the past year. On the other hand, we've got a handful of these that are all in this area right here, and that look like they might be pretty interesting sectors to consider because of the way that they've underperformed. The S&P 500 is up about 35%, 36%, as I mentioned, over the past year, whereas these sectors are here's up 14%, up a little about 11%, 9.5%, et cetera. So they're clearly underperforming. It doesn't mean that they are doing badly, it just means they haven't been going up as much. That also tends to mean the market is kind of not really paying a lot of attention to them, possibly even dismissing them outright. And that becomes more and more interesting as we go. So the list of these, XLB is the materials sector. So I'm just going to go ahead and pull up a document here really quick. Try to adjust my sharing settings here. See if I can entire screen. There we go. Okay. Going to shorten this up just a little. Okay. There we go. So the first one, let's call this sectors to watch. Number one, XLB, which is the materials sector. Another one is this blue line, XLE, that is the energy sector. You don't need to worry about memorizing these, but you can certainly look them up. They're easy to find on Google or the Standard & Poor's website. This is the energy sector. This one is XLV, which is healthcare. I don't even remember all of these all the time, so sometimes I have to look for some clues. This is the healthcare sector. So hospitals, health systems, even some pharmaceutical companies and healthcare providers like Medtronic and companies that provide medical equipment, healthcare equipment fit into this category. This somewhat orange line. Let's take a look at this one. This is XTN, which is transportation sector. Two, three, four, five, six, seven. So there's a fair number here that are looking kind of interesting. XLU, this is utilities. So Dominion Energy, some of these others. Think about your gas bill, electricity, etc. This one is the real estate, XLRE. So these are going to be real estate. These are going to be home builders, real estate holding companies, and the like. That's not too surprising, given that it's underperforming, given the state of high interest rates and the difficulty in general in the U.S. now to get a loan and to be able to buy real estate. That's been a sector that's uh, had a little bit of a more of a struggle lately. So, and then this last one is XLP, and this is the consumer staples. Consumer staples represent companies that I consider to be pretty defensive in nature. I like to pay attention to this sector when economic conditions are a little bit more difficult, because these are going to be companies like grocery stores and others that see consistent revenues even when the economy is a little bit more difficult, simply because they produce products and services that everybody needs, even when they're having to tighten their belts. You're not going to stop shopping for groceries. You're not going to stop buying toilet paper or other personal goods, those kinds of things. You're going to find ways to make those fit in your budget. So these are all very, very interesting sectors. The material sector is one that I like, because that's an industry, or excuse me, that's a sector that is made up of a lot of chemical companies and fertilizers, and a lot of companies that produce the that provide the raw materials that other companies in other sectors use to produce things like rubber tires and all kinds of other finished goods. So they touch about just about every other sector in the market. So there's some sectors here that are actually looking kind of intriguing, just from the way that they're underperforming the market right now. Another way that I really like to pay attention to what is going on in the in the broad market, and to consider these different sectors, is to try to think about value. And so it's not just enough to say that an industry is underperforming the S&P 500 from a price standpoint, but what does that actually mean in terms of what that is doing to the stocks that are involved? Are they excuse me, let me know really quick. I'm just going to do a little test here. Respond if you don't mind. Tell me if you can see what I just typed. FEs, you're the only one here that is that's paying attention right now. Can you see what I just put up on the screen? Can you see this? Okay. Thank you very much. You said yes, Aroni, which is nice. Okay. So here is one of the things that I like to do, and that's to pay attention to PE ratios for the different sectors that I'm trying to follow. Um, since these sector ETFs are based on a grouping of the stocks that make up each sector, and each of these stocks have a carry a PE ratio, that means that each of these ETFs have an average PE ratio as well. It's reflective of the average of all of them. That means that when I can compare that to the rest of the overall market, I get a way that I can begin to compare and contrast each one of these sectors with to their relationship with the S&P 500. So let me break down how I've done this. I'm going to, sorry, I'm going to pull this over and I'm going to, in fact, I'm going to expand this a little bit, make it a little bit easier to see. Let's go even bigger. There we go. Okay. So this is a table that I keep track of and I update periodically of the PE ratio, not only of the S&P 500, but of each of these different sectors. So we can see as of right now, the PE ratio for the S&P 500 is about 24.79. Now, the issue here that I'm not trying to identify is whether or not that's a high PE ratio or whether any of these are also a relatively high or low PE ratio. What I really like to do though is to compare the PE ratio of each of the sectors that I'm interested in against the S&P 500 to see if they are if they may be a little bit undervalued relative to the broad market. And that gives me a way to filter these lists of stocks. I have 7 ETFs right now that are interesting just from a price standpoint. I'm not sure I want to try to follow or really dig into all 7 of these sectors to try to find some that might represent a reasonable and good value right now. I like to try to compress and I like to try to condense my analysis as much as possible so I can be as efficient as possible in finding good opportunities to make the kind of trades that I prefer with Rebel Income. So, as we can see, one of the ETFs that was really interesting from a price standpoint was real estate. That's right here. But their PE ratio at 33.73 is relative to the S&P 500 is actually above it by about 36%. So what do you think? Does that imply, again, I'm going to be looking for a response here. Does that imply that the real estate sector is a good value or might it be a little bit overvalued? What do you think? This is one that is relatively speaking is going to be a little bit overvalued because it's the PE ratio is above the S&P 500. Healthcare has a similar phenomenon going on where we have a PE ratio 33.02, just a little bit below real estate, but relatively speaking, also about 36% higher. So these are a little bit less interesting, and they're and even though they're coming up in my list based on price action, I'm probably not going to really want to pay attention to those particular sectors as much. Let me try to clean this up. This is getting a little confusing. So we'll just go ahead and cross off. Here's healthcare, not so great. Here's real estate, not so great. Let's see, let's consider some of the others here. Where is materials? They're not on the list right now. That's one that's missing. Well, let's move on then. Go ahead and cross that off for now. How about energy? Well, energy is really interesting because besides the fact that it was at one of the sectors at the low end of the price range, it is also, here's XLE Energy, has a PE ratio of 13.05 compared to the S&P 500 at a little below 25. That means that this is a sector that is running at a relative discount of almost 50%. my preference and my personal uh, my system is built to try to identify stocks that are undervalued in the market, that have a reason to need to go up, that based on the book of business that they offer, they should be priced higher than they are right now. And so this gives me a way to try to think about that kind of a perspective, and apply it against an entire sector. So energy looks like it could be pretty interesting. So I'm going to circle that one over here in green, and that's going to be one I'm going to pay attention to. How about transportation? Well, that's all, the just a little bit above energy right now, with a PE ratio about 15.03. That means that it's about 39% undervalued relative to the S&P 500. That's also interesting. That's useful. So I'll go ahead and circle this one. Utilities are not quite as high, so I'll change my color here. Here's utilities at 2005. It's about a 19% discount, which is not terrible. In fact, that's generally pretty attractive. So that's one that's also generally worth paying attention to. So I'll go ahead and circle that one in green over here. Again, that's kind of messy and I apologize. Consumer staples is also undervalued, but I'm gonna take a little bit of an exception to this one. Here's XLP Consumer Staples. Its PE ratio is not far off from the S&P 500 at 23.4. So that's only about a 6% discount, relatively speaking. I'm really looking for more than that. Doesn't mean that there couldn't be some undervalued stocks in that particular sector, but they're probably going to be harder to find. So if I'm using this idea of sector rotation to try to find some things that look like they could give me a way to find stocks relatively quickly, increase, speed up my overall analysis, and give me information that I can provide about potential income generating opportunities at really attractive prices. It looks like right now the best opportunities are coming from energy number one, transportation number two, and utilities number three. Why am I not talking about financials? Well, the financials are also pretty interesting strictly from a valuation standpoint. So we have about a 34% discount in that case, and that is interesting. But if we go back to our stock chart, I clean this up a little bit. Financials, XLF, oops, sorry, are going to be right here. They're up about 27% for the year. Again, that doesn't mean that they couldn't be an attractive value. There are some interesting banking stocks out there, but there's also some others that are probably a little bit overpriced right now. It's kind of a little bit more of a mixed bag, and again, that makes it a little bit harder, a little bit more complicated to find the kind of trading opportunities that I like to work with for the Rebel income system that you'll see me usually write about or talk about in my videos. All right. Does that help people? Does that help you out? Does what I've outlined make sense? Are there questions? If you have a question uh, about what I've been talking about, you can go ahead and post that in the chat. All right. Well, I do appreciate your time and being able and seeing a few of you tune in to the live stream. As I mentioned, I'm going to make this recording available on my YouTube channel. If you're interested in seeing more detail on a regular basis, I publish daily content on my Patreon page for all of my patrons. If you're interested in that, you can go ahead and go to, I'll just go ahead and put the link here in the chat. Go to patreon.com/Rebel Income System. You can sign up for a free 7-day trial of any of my patron levels, and you'll get access to a lot more additional content. For example, I do I do analysis of individual stocks 3 times a week, and publish what my opinion about those stocks, as to their fundamental overall strength, their technical patterns, their overvalued or undervalued status 3 times a week. I publish an income generating trade at least once a week on that channel as well. Specific, so my patrons have exclusive access to that, as well as a live webinar that I do every week while the market is open. Thank you, though, everybody. I really appreciate your time. We'll be doing some more of these live streams, so please pay attention to the channel. Look out for those, and hope to see you again next time. Thank you. Bye.